What's going on, everybody? Nate Hare with New View Trust Company. Today, we are talking all about notes and lending inside of an IRA. Why would you want to do it? How is it done? And I've got a special guest speaker, a good friend of mine, Keith Baker, and we're going to have him give you guys some additional education about note investing. He is a note investor. He also is the host of the Private Lender podcast, and we will get to him very, very shortly. But today, let's just jump right into it because I want to give our guest speaker some ample time to share his knowledge of note investing and specifically note investing in a self-directed IRA. So again, my name is Nate Hare. I am the Director of Sales at New View Trust Company. Just to give you a little background about myself, I've been in the self-directed IRA industry for about 10 years now. Prior to that, I was in lending. I actually come from the mortgage industry, where I learned a lot about real estate, a lot about financing. And I will tell you from my own personal experience, when I was in lending, no one ever did they mention to me that I can lend out of a retirement account. So it took me about 10 years to luckily find this information, and it just blew my mind. And I thought to myself, I think everybody should understand what's truly possible in retirement accounts, especially if you are a lender or looking to be a lender or a real estate investor. So we're going to talk a little bit about self-directed IRAs just in general. I'm not going to spend too much time on that. If you want the more education on the beginner stage of a self-directed IRA, go back to some of our previous education where we expand on that. But today I do want to just recap on what a self-directed IRA is, the types of accounts that can be used. Why would you want to use an IRA to lend out of? What are some of the benefits there? And then turn it over to our guest speaker. So let me jump into my presentation, and we're calling this Be the Bank. Got my slides up here. Do I need to switch this, Grace? Oh, I got it. All right. So just a little background about New View Trust Company. We are a licensed and bonded trust company. We run our administration out of Florida. Now, we have clients all over the country, though. And our clients are IRA holders that invest in alternative assets instead of traditional assets. What are traditional assets? Stocks, bonds, mutual funds, CDs. What are alternative assets? Real estate, notes, investments into startup companies or private stock, investment into syndications that might own apartment buildings. With an IRA, you can invest in anything. Most people don't realize that. But to invest in the things that we're talking about today, which is promissory notes and lending, you have to use a self-directed IRA in order to do those types of investments. I know a lot of the current clients understand that, but for anybody new, it's always important to touch on that very, very briefly. Currently, we manage about $1.7 billion in alternative assets for 15,000 clients. So we are not a new kid on the block. We've been doing this for 17 plus years. So we are a leader in the industry. So that goes out to anybody interested in working with a company that understands self-directed IRAs. New View Trust Company is the place. So what are the products? What are the accounts that we have here at New View Trust Company that can be, quote, self-directed? There's actually 7 types of accounts that can be self-directed. Is that moving? All right, sorry. There's 7 types of accounts that can be self-directed. For current clients, this is a good one as a refresher to look back and think of the accounts that you have at New View or otherwise, and decide if there's plans that you are missing out on. The reason I always say that is because oftentimes I see clients, non-clients setting up one account at New View. I find it very hard to believe people out there only need one tax advantaged account out of 7. But so this is just a reminder as to what types of accounts can be, quote, self-directed. What types of accounts can you lend out of, buy real estate out of, and buy all the alternative assets that are available to you out there. You can break these up into different categories. The personal plans are the ones most people are familiar with. That would be your traditional IRA and your Roth IRA. Only difference in how those work is how they're taxed. One's taxed at the end when you take distributions. The other one, the Roth IRA, is taxed before you put money in. So it can grow actually completely tax-free. If you go online and you're looking up self-directed IRAs, you'll find that a lot of the gurus love talking about the Roth IRA because you have the ability to grow your investments completely tax-free and penalty-free. I'm not going to spend a whole lot of time on this, but what I will do is plant a little seed in your investor head there, and think, if I'm going to invest in notes, and if I can do it the way that a lot of the investors are doing it today, I might see double-digit returns on an annual basis. I'll give you a little background. Notes are probably the most prevalent alternative assets we see in the self-directed IRA industry. Almost 50% of the assets most self-directed IRA companies hold are promissory notes. Now, most of those promissory notes are secured by real estate, but you can hold all different types of promissory notes: unsecured notes, convertible notes, net profit notes. I mean, the list goes on and on. But if you're talking about notes secured by real estate, which is what we're going to focus on today, and you're doing it the way most investors are doing it, short-term notes to real estate investors. I personally like to do 1-year notes to real estate investors. Why do I do that? Well, most real estate investors only need my money for 1 year, and then they refinance me out or sell the property that they used my money to buy and flip. But with those types of strategies, I will tell you, a lot of times the Roth IRA is more attractive, because as I'm doing short-term notes, I'm getting my principal and interest back in 1 year. And if you agree with Einstein, the 8th wonder of the world is compounding interest. So if you're using strategies like short-term promissory notes secured by real estate and you're compounding your interest, think how effective that becomes in a tax-free account like a Roth IRA. Just stuff to think about. And these are some of the things we cover in some of our consultations if you contact us here at NewView. Employer plans can also be self-directed. That would be your simple IRA, your SEP IRA, or your individual 401k. We have those here at NewView. And we also have specialty plans, which would be your HSA and your ESA. All 7 of those plans can be self-directed. And here's the real cool thing when you are creating notes. If I'm going to do a loan to a real estate investor, I'm going to partner all the accounts that I have at NewView on one note. Okay. What's that do for my retirement account, my health savings account, my education savings accounts for my nieces, or if I had kids, my kids, is it gets all of my tax exempt or tax-free buckets working at the same time. And the cool thing is when borrowers pay my IRAs back or pay NewView back, NewView splits the check, the interest check that I get from my borrowers, into my different accounts pro rata. So thinking back to those accounts, if you're using 7 types of accounts, you're getting 7 different tax benefits and different uses of different buckets of money. So always think about what other accounts can I be using. And these are the investments that we see most commonly in NewView accounts. We see clients that hold real estate, fee simple real estate, commercial real estate, multifamily real estate, land, the list goes on and on. The difference between these assets and notes is these assets, you got to be a lot more active, meaning a lot of times you have to be the one finding the property. Sometimes there might be a rehab involved, so you got to hire contractors. So truthfully, even though we talk a lot about real estate in an IRA, and truthfully, it is a great investment if you do it right in an IRA, is that most clients don't tend to do that investment strategy because of the work involved. When it comes to notes, sorry, go back to Joyce. When it comes to notes, we are actually doing less work. So that's what I really like about note investing, is that when I'm holding a note as my investment, not the real estate directly, is that the person doing all the work is the real estate investor, right? They're putting in all the sweat equity. I'm just using my IRA as the capital source. And we'll talk a little bit more about the benefits, but I'm just kind of giving you a little bit of background as what type of alternative assets do we see that maybe you don't see online, because you'll see a lot of people talking about real estate, but notes is the #1 alternative investment that I've seen in my 10-year career at the self-directed IRA companies. So, and then you can invest in other things like private stock. We actually, even at NewView here, we hold crypto. If you want to invest in crypto, that's not the topic today. We will have that topic soon. Or invest in just traditional stock. We're actually one of the very rare companies that allow you to invest in traditional stock here as well. So, but we're sticking to notes. So let's get to some of the advantages when you talk about investing into promissory notes. So I have this up here because people always say, well, you know, I've got some money, I want to lend, I want to be a lender. Why would I use my IRA? Well, most people understand your IRA is different or treated differently when it comes to taxation. this is a hot topic right now. We're heading into the end of tax season. So people are finishing up their taxes. They're getting their statements on how much they owe the government. And they're going, wow, I owe a lot in taxes. Or you're thinking, well, and again, this is not to get political by any stretch, but what's going to happen in the future with capital gains tax, right? Am I going to be taxed heavily as I invest my own personal money? And if I am, how do I work within that environment? Well, an easy way to work within that environment is you don't have to think outside the box to do that. You just have to realize the box is bigger than you imagined it. And what I mean by that is think about how your IRA can be the investor instead of you, the individual. Because if you're trying to maximize the dollars you have, most people's dollars, most of it is in a retirement account. What is it invested in? And can you apply your knowledge as either a note investor or a real estate investor to my IRA and have my investments grow completely tax-free, no capital gains, no taxes if it's a Roth IRA or an HSA or a 401k. There's better tax advantages in an IRA than you as an individual. So I always say this, if you're not utilizing an IRA or not utilizing a HSA or a ESA or a 401k, if you're not using any of those buckets, you are just a taxpayer for life. Right. So think about that as we talk about note investing. Yes, you can do it outside of an IRA, but there's a lot of benefits to doing it inside of an IRA. So what would be some of the benefits? Some of the benefits of specifically note investing, I kind of touched on one, it's passive. When you look at the rules with IRAs too, you have to play a passive role. You're kind of the quarterback of your investments when you think about your IRA. But you're not allowed to run every play, meaning if your IRA buys a piece of real estate, there are rules that prevent you, the IRA owner, from fixing the real estate up personally. So there are some rules that you got to work within, which we'll touch on here in a sec, that make you a passive participant to your IRA's investment. Now, that might sound a little weird to some people because they think, well, I put the money in there. Is that my money to play with? Well, technically, your IRA is a separate entity. You pick the investments for your IRA, but your benefit comes from the distributions you take from the IRA. Very different. So you're not allowed to benefit or self-deal or extend services directly to your IRA. You're only allowed to direct where it invests, and then you take your benefit from distribution. So notes are passive, which work very, very well. You stay out of trouble with the IRA rules. Plus, how much work do you really want to do with your retirement assets? I always think that the best type of retirement is sitting back and watching the money come in. You don't want to work on your assets. And if you are a full-time investor, I think most of your work should be dedicated to the deals you're doing outside of your IRA, because those are the deals that put food on the table. Your IRA is the icing on the cake, or the investments you put on the shelf. You don't want to worry about those. You don't want to have to deal with those on a day-to-day basis. So again, having a passive investment strategy like note investing is great in an IRA. Also, diversification. So any wealth advisor will tell you should be well diversified. I would argue that diversification is not having high risk mutual funds, medium risk mutual funds, and low risk mutual funds. That's just a bunch of mutual funds. Nothing against mutual funds, but true diversification means holding some of those traditional assets in your retirement portfolio, and then have some alternative assets in your portfolio, whether that's real estate or notes. Having alternative assets is the best way to diversify your entire portfolio. And I'll give you a little statistic as to the rich and the wealthy already are keen to this. And this is why I'm so passionate about teaching this, because a lot of people don't get this education, and we certainly don't get it in school. I touched on the tax savings. Tax savings is a huge benefit to investing in anything in an IRA, but specifically notes, especially when you go back to the ability to compound your interest and do short-term notes. And we'll touch a little bit more on that when we bring Keith in. And then the other thing is the social implications of your IRA's investments. It's a little bit of a cheesy concept, but I think it's true, especially today, is what else is your IRA or your retirement assets doing for us, either in the greater community or however you look at it. And the reason that I mention that is because I see it on a day-to-day basis when clients take their IRA and they're in a lender's position to a local real estate investor. There's so many other positive things that are happening during that investment besides the client or the IRA owner getting interest payments. You're putting a local real estate investor to work, right? And if they have a good track record, and that's part of the process of finding people with good track records that you're loaning to, but they're taking your money and it's not just stopping there with the benefit. Most real estate investors, at least the ones I'm working with, are actually not the ones that are swinging the hammer. Those real estate investors, or the ones that I'm lending to, are the ones that are finding contractors. The contractors often hire subcontractors. Both of them are buying equipment, lumber, paint, light bulbs at local businesses. And again, this is all started with my IRA money. So not only am I getting a return in a safe passive investment secured by real estate, I'm also putting people to work who are putting money back into our local businesses. And then when they're done with the property, they put up the white picket fence, they sell the property to a family needing a home. They hold it as a rental and refinance me out, or they get creative and maybe sell or finance it to a family that can't get conventional financing at a bank. But the end result of my note investment is a real estate investor providing the American dream to somebody looking for a home. And I just think that is a great thing to think about when you think about your retirement investments. Here's the zinger that I kind of alluded to. And this is actually taken from a Forbes article back in 2020, March of 2020. And it was a really interesting article. And if you dig into the article, it says this about retirement accounts. Only 2% of IRAs currently in the United States, only 2% are self-directed, meaning only 2% of the IRAs are custody or administrated by companies like NewView. 98% of the IRAs are administrated by Fidelity, Charles Schwab, and again, holding traditional assets. If you look at the statistics outside of this quote too, is the average American family has about $65,000 in a retirement account when they retire. So that made me think, okay, 98% of America's retirement is invested traditionally, and the average is 65,000. Well, in the study that Forbes reported on is that when they actually looked at the high dollar IRAs, the $5 million IRAs, wouldn't you like to have one of those? But when they looked at the $5 million IRAs, the ones that were valued above that, 25% of the assets within those accounts were alternative assets. Again, most people don't even hold any alternative assets in their retirement account, but a fourth of the assets held in the $5 million IRAs are alternative assets, like notes, like real estate, and like all the things that I mentioned earlier before. Before we get into the topic and talk about how your IRA can lend and the different things that you want to look out for, the mistakes you want to avoid, before we talk about that, I do need to touch just real briefly on the rules when it comes to IRAs. And just remember this, a lot of you clients understand this already, is that when it comes to your IRA's investment, there are certain people you can lend to, and there's certain people you can't. And it's more important to talk about the people that you cannot lend to. When it comes to your IRA, you can't use your IRA to loan to yourself, right? It's self-dealing. You make the decisions for your IRA, you also make the decisions for yourself, and you can see where the conflict of interest lies in that scenario. So before you lend, just keep in mind the rules. And if you don't understand the rules, that's why you call NewView, and then we'll kind of explain it to you and just make sure that you're doing things on the up and up. But you don't want to run into a prohibited transaction, which would be me using my IRA to loan to myself, me using my IRA to loan to my spouse, or any of my lineal relatives, lineal ascendants, which would be parents and grandparents, lineal descendants, which would be kids, grandkids, and their spouses, and any companies those same people own, control, manage, or are highly compensated by. It's a specific list. They're called the disqualified people's list. And the reason why those specific family members are disqualified, it's because those are the ones that usually inherit your IRA when you pass, right? If I pass away, my IRA is most likely statistically going to go to my spouse or my kids. So if they're going to inherit the IRA, they are also fiduciaries to my own plan. So outside of that, can you loan your IRA to your brother who might be a real estate investor, or your sister, or your aunt, or your uncle, or your cousin, your niece, or your nephew? Technically, by rule, you can. But this goes a little deeper. Do you want to invest with family? Sometimes I think it's best to keep family and business separate. That's just me. But just remember, you can't loan money to yourself or those family members I mentioned, but that leaves everybody else as a potential borrower with your IRA. And we'll talk a little bit about how you might vet a borrower and what things to look for. So how do you do it? Before we get into it, it's real easy. If by the end of this presentation, I think you'll have an idea whether you want to do it or not. And if you're currently doing it, you understand these steps. But if you want to hold a note investment, if you want to lend out of your IRA, you got to have an account at NewView, right? You can't have an account at Fidelity. Fidelity won't allow you to do it. None of the traditional custodians will allow you to do it. So you just open an account with us. And I got a little special promo. If you're not a client, I'll encourage you to be a client. Once you have an account open, a self-directed IRA account open with us, you fund it by either transferring some money over from one of your other IRAs, rolling over an old 401k, or just making a contribution. Again, our IRAs here are no different legally than an IRA at Fidelity. We just hold different types of assets. Step 3, this is the big part, and this is what Keith is here to kind of help explain too, is locating your investment. How do you locate an investment? What are the things you want to look for? What are the mistakes people make when you locate the investment? With a self-directed IRA, the self is you, the IRA owner. So you have to find the individual that you're loaning to. We don't have people that are looking to borrow money. We can't provide you that type of information. Or are you buying an existing note? There's a lot of resources that we can touch on, but you have to find the investment. And NewView just acts as the facilitator of your IRA making the investment. So what you would do is you just provide us some investment docs, which are really pretty simple. In the note world, it's really easy. If you want your IRA to own a note, just give us a copy of the note and fill out our buy direction letter, and we can fund that investment in 24 to 48 hours. I'm just touching on this briefly, just to kind of give you an idea. And we'll talk more about this through the actual case studies that my good buddy Keith is going to present here. And Keith, are you there, my man?
I am. Can you hear me?
I can hear you. I want to thank you. Me and you go back many, many years. We've done a lot of things together. I've been on your podcast.
Yep.
I will say this, even though I am restricted from endorsing investments, endorsing sponsors, and yada, 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 people get it. I will say Keith is definitely one of the good guys in the industry. And what I mean by that is he's always available to share information. And he's not sharing information about note investing because he read it in a book. He's sharing it because he actually is active. He does this not only in his IRA, but outside of his IRA. He gets other investors involved, so much so that he started the lender podcast with the best name in the industry, the Private Lender Podcast. You can probably sell just that name alone for a lot of money. But again, thank you, Keith, for joining us. I really appreciate your time.
Well, Nate, thank you for having me come on. And yeah, I listening to the intro there, have you been doing this a decade? Because that means I'm old.
Yeah, it's been a while.
So yeah, well, thank you for the kind words, and just a little background. There are a ton of gurus out there that'll teach you how to raise private money, but I haven't found one guru that teaches private lenders how to stay safe, keep their money safe, and really profit and really utilize the tool that private lending is and can be. To your point, Nate, it's passive. That's why I like it. I tend to be lazy. To my point of getting older, I don't swing hammers anymore, and quite frankly, I don't want to manage crews. But I do love real estate. I do love lending on real estate. So as long as there's someone out there willing and hungry enough to go do good work and be a good borrower, then I'm all ears, and I'm ready to lend them some money to go make it happen. So shall I share my screen?
It's yours to take away.
Okay, let me bear with me just 1 second. And hopefully, can you see it?
We can see it.
Okay, so putting the power of banks into your self-directed IRA, and I love it. So let's go ahead and move over to who is Keith Baker and why you should care. So I bought my first investment property from my parents. They had a lot that I paid $1,100 for because it was never developed, and I was so desperate just to have a deal and say I had a real estate deal. I bought property. I actually turned my father into a lender and got him to owner finance it, the lot to me. So I paid him $100 a month over the course of 11 months. And then that's how I got my first property. So I'm not going to come out of the gate with glitter and glam and tell you I'm the greatest thing to the real estate investing industry. I was a great house hacker. I found that if I could move in to a place, I enjoyed doing the work myself. And in fact, back in 2006, I bought a house in Nate, you don't know the Spring Branch area of Houston. I happened to buy it at the right time. And once I rehabbed it 7 years later. The house had gone from 120,000 to 315. That's my greatest investment ever. Of course, I put that into the down payment of my now house so I could live in a decent neighborhood. I tried landlording and I failed miserably. I don't even think with the depreciation I came out ahead. And so I kind of gave up on that. But after I'd been working on oil rigs, and it's very difficult to manage any investment or even your life when you're constantly on the road going phone call to phone call. And so it led me to become an active private lender, because when I was home, I could go by the property, take a look at it, still be involved and still have my network active while I was away working. But that private lending, once I understood it and really got the mechanics of it, I said that this is for me. I parlayed that oil rig experience into, I became an insurance adjuster for the oil field, which has been quite interesting over the last 12 years. I've handled in excess of $2 billion in other people's money. That's primarily the money at Lloyd's of London, but also insurers such as AIG, Hartford, and some of these names you see over here in the United States. And I taught my first private lending class back in 2016 because nobody else would do it. And I was the only one that seemed to have any knowledge on the topic. So the local RIA I was a member of asked me, and I said, sure, why not? And then all of this sort of kind of fell into place. I began the Private Lender podcast at the end of 2017 with the purpose of just getting awareness out there, but also to keep people from being sold a bill of goods by somebody who just wanted to borrow their money, which I saw happen from time to time in the Houston area where I am. And so I've come now I'm going to launch the Private Lender Academy, which will launch next month. And this will be twofold. It'll be a course to teach people how to close the gap. To Nate's point, custodians don't give tax, legal, or investment advice, but I can certainly give you my opinion based on my experience of being a private lender. So wanted to put together a course to help people sort of, what took me 9 or 10 years to put together. I could put all that experience plus my mistakes into a few hours course, but then you could give some coaching and hold people's hands as they went through their first private loan, because it is a big deal. It can be overwhelming. There's a lot of money that you worked hard for, that money to put it in your retirement account. And the last thing you want to do is see something happen to it. And so my goal with the Private Lender Academy is to put my mistakes into that, to show people where I screwed up and how easy it was to avoid that mistake, but so that they can use that same strategy as they press on in their investing. So yeah, I openly speak about my mistakes. I've gotten a little bit of notoriety on various podcasts. Nate mentions this is I guess this is your third time on no, I'm not on. No, this is your show, not mine. Okay, so this is my first time on with New View, but Ron LeGrand, Larry Goins, Victor Menashe, and Gary Boomershine, and of course Mitch Stephen. I gotta mention my Texas buddy who does all the owner financing sales, and then Reed Gooson's a great guy out in California, but he's originally from Australia, who's crushing it. So that's sort of my background and what I do, and what I wanted to bring today is sort of the 3 biggest mistakes that new private lenders make. I've been there. I've been in the classes, learning about private lending and being told multiple times, yes, the IRS does allow this. This is legal. It is possible. So I've sat in those shoes, and I remember the insecurities behind it. So I try to break it down into some simple steps or things to avoid, and never trust the borrower or fall in love with their enthusiasm for the deal. Right? Real estate investors, they get a deal, and that thing could have been daisy chained on the wholesale. Everybody gets it and adds another $5,000 to it, and then they come to you for private lending, and they're just totally in love with it, and you got to look at it and let them down. That's your job as the lender, is to block that pie in the sky. And I like to look at it. I like to be very pessimistic in the front end, because if the more pessimistic and realistic I am up front, the happier I'm going to be when that loan pays off and as agreed. So I've myself have listened to stories of some very passionate real estate investors and agreed to loan money to them without really doing any proper due diligence or putting any measures to protect me or my money. So number one, don't fall in love with the borrower's story buy into their enthusiasm. It may be a smoking hot deal, right? But you're going to want to verify that it is a smoking hot deal. Second mistake is not demanding the borrower have skin in the game. Everybody wants to use your money with zero money down. And I think that is a huge mistake, because there was a little caveat with a self-directed IRA that I knew, but I forgot. And that is, any money that is made off of that investment or my loan has to go back into my IRA, my account that it came from. But so do any expenses associated with that. So if I don't charge any points, or I don't have any money down, and I never receive a payment, and that loan goes to foreclosure or default, then I've got to put contribute the foreclosure money into that account, or take it out of that account to pay the attorney to do the foreclosure. So what I like to do is, in Texas, an average foreclosure is about $1,800. So if someone can't come to the closing table with at least $1,800 or $2,000, then they're not my borrower, because I get that money up front. God forbid I have to foreclose. It's already there. I don't have to worry about where the money's coming from, or, can I move it from one tax deferred account to another? It's all there. And make sure that that person has skin in the game. And just that $2,000 down is just one example. The other is keeping your loan to value low, and not getting, going to the 75, 80% that the current market is sort of dictating. As long as your borrower, if it's fine if they default, but I want them to feel the pain as well. And I want them to have that as a motivator, not to feel the pain. So always demand that your borrower has skin in the game. And then the third one, sorry, I see a lot of people chasing risk. They get deal hungry. Especially newbies, like they just want to get their first one sort of done. And a lot of times what they'll do is they will provide a loan on what I would consider a marginal deal. And a marginal deal would be that 70%, let's say, loan to value, all in. But they take a marginal loan, and then the borrower comes back and says, well, we're going to need a little bit more money. And the lender then raises the interest rate on the loan, right? The underlying risk has only gotten worse to the lender. So raising interest rates to chase that risk is the wrong idea. In fact, you want to do the opposite. If something comes up and they need more money, then they're going to have to come up with it. And I let them know that going straight into it, that I blend my criteria are in bands, percentages, and I don't go above them. So if something comes up, they will need to have the money to, do the termite damage or whatever the unknown repair needs to be. So that's also goes back to making sure your borrower has skin in the game. Make sure they have some money for contingencies set aside just for such occasions. And so I'm going to share with you guys now two loans. One is my horror story, and the other one is one from a student of mine I've been coaching along here recently. And this is a 7024 Leslie in Galveston. It's a lovely 2-1 that was flooded during Ike. That was back in 2008, and basically sat there. And my friend had purchased it, and she needed the money for the rehab. I said, okay, sure. Good friend of mine. I've been doing some work with her, and agreed to put my money on a second position lien. And I believed and listened to her story, basically, which at the end of the day was just that. It was a story. Next thing I know, a few months later, I haven't received any, and I even let her go 6 months. I didn't take any payments for 6 months, which is that's maybe number 4 on the list. Like, don't do that. Give yourself a trigger for default every 30 to 60 days. Anyhow, so long story short, I get a call from an attorney saying, just want to let you know that I represent the private lender who has the first position lien, and we're going to foreclose. And if you want to keep the house, it'll be an additional $54,000. And the house is yours. I run over to my self-directed IRA. I don't have that much money in it. I can't. And it was in my Roth, so I could only put $5,000 at a time anyway, right? So I got hung out to dry on that one and learned a very, very valuable lesson to, even if it's a friend, and just, you got to trust. You'll see here on this side of me. Yeah. Never trust, always verify. That is my hashtag, one of my hashtags, and what I live by. You got to see it yourself. If they're telling you the house is worth 350,000, you verify that, right? Just make sure, because where I really messed up with this, and this is where it gets embarrassing, is to the right of the Leslie property, just above the Academy, their logo. That's a part of a church. To the left is obviously a much larger 2,000 plus square foot house that's elevated. And everything, all the comps that she ran and provided me were based on these houses that were much bigger, were had newer construction, and were all elevated. Had I simply done a little bit of due diligence just on that fact alone, I would have said no to the loan, and I would have saved myself the money and the heartache. So there's a prime example of where I was young, I was dumb, and I trusted the borrower. I fell in love with her ideas for the house, what she was going to do, and none of that came to fruition. And at the end of the day, really, she stole $18,000 from me, plain and simple. So my goal with all this is to share that mistake, so that you don't make $100,000 or $180,000 mistake by falling in love with the investor's story as well.
Keith, can I add something real quick?
Sure.
First of all, much props for sharing horror stories, because people learn more from that than the home runs. And you see it all the time. The gurus they want to tell you about all the home run deals, but they never talk about the ones that they screwed up on. And there's a lot of lessons there. And I just want to point out, to the viewers out there, he kind of mentioned one thing that's definitely important to understand is that, first of all, when you're structuring these notes and you're doing it through a self-directed IRA, it's up to you to decide what the terms are between you and the borrower, right? If you don't, hopefully you've got some, financial friends around you that can maybe give you some tips, but New View, unfortunately, we can't tell you how to structure a note. And I really like that he pointed out the 6-month no interest piece to it. So that's something that you want to be aware of as a lender, especially with your IRA, is what's the borrower doing with the money, and how lenient do you want to be? Because in a lot of states, what happens is if and I see this all the time, you probably see this too, Keith, is somebody will do a loan to a real estate investor and they just say, well, just pay me back when the note matures, which could be a year or 2 years, right? And they're not collecting any interest during that time. Here's the problem. Is if the borrower is in trouble, or you're like Keith, you go back and you look at the comps and you go, wait a minute, I think she just fed me a story, because look at all these houses that are elevated. You could run into that and see all of that. But if you're not collecting interest, if the note doesn't say that they have to pay interest payments, you technically can't call that loan in default. So he brought up a great point there, is that when you structure these notes, be cautious on how you structure it as to when you're asking for the payments. I've done notes to real estate investors, and I've done the same thing, Keith. I've done 6 months, no interest. You don't really want to go much longer than that, because remember, if the borrower's in trouble, how are you going to call them in default if they're not actually missing payments? So I just wanted to point that out and really stress that as a great point you pointed out.
No, that's one. Yeah. And the minimum I'll do is quarterly, but those are different deals, right? It really depends on the property and what's going to be done with it. So those are more, I would say, I call like developmental deals, right? We're dealing with a larger entity or structure that's moving a lot of dirt and land to put something together. But from this single family, example, always. And there are other triggers for default. I would highly suggest you talk to your attorney that drafts your documents to talk about what other triggers for default are allowed in your state. I know Texas and Florida are similar, but I don't pretend to know Texas law or Florida law. But I know that there are certain things that you can do performance based, right? It's not just payment, but let's say the project has to be done 25% complete within 30 days. Right. Or, but anyhow, I would also suggest speaking to your attorney about finding other alternative triggers for default other than just lack of payment. Another way out, you can basically say that. Yeah. But basically, at the end of the day, this is, it's your money, it's your terms, right? Mm-hmm. So I like, people say, if the borrower doesn't fit my criteria or the property doesn't, then they're not my borrower. Mm-hmm. And it's not a personal thing. It's just, I've got my bands that I like to operate in. And some people invest within those bands and others don't. And it's real simple. But if I had learned the power of the and value of the word no here early on, and really at the end of the day, I mean, I'm grateful that it was, it was 18 grand. Yeah. And that was a big chunk of my account at the time, but I learned, right. And, at first I was, there's a little bit of, God, why'd you do this to me? Or universe, why'd you do this to me? And now it's, well, thank you, because I would rather pay this lesson, have this lesson here than, like I said, 180 or $300,000 hiccup because somebody has a luxury house that's perfect for a vanilla ice flip or whatever, and lose it that way. So, didn't like losing the money, but glad that I did, and that I could, and it was a small amount in comparison. So it lessens the sting a little bit. But another mistake I made was I bartered for help with some online marketing from this friend, and none was ever given, and I never pushed it either. Right, so there was I didn't even get that part of the loan, and that's not her fault. I look at this mistake as it's all on me, right? Like she shouldn't have lied. She should, yeah, should have. But at the end of the day, it's my money, and it's up to me to make sure that it's safe. And I didn't do that. So anyhow. That was one of my, and I've also had my money held hostage. I've had it stolen in this account, like this case, and I've also had it held hostage. So you definitely don't want to do that. Let me back up a little bit here. Okay, so yeah, I loaned 18,000 out in the second position, was lied about the rehab and the schedule. First position foreclosed. Anyhow, it was all in. I would have had to put $72,000 into a house that would only have been worth $65,000 at best, because those types of houses really weren't selling, right? Those little houses are getting torn down and they're building up, it's on an island, a barrier island in the Gulf Coast. So, yeah, big, bad one there. So that's, I call that an $18,000 seminar, but it was a lot longer than a 3-day weekend. So anyhow, one of my, friends and students here, we'll call him, student P. There's a very charismatic real estate investor in Houston, and he's a great used car salesman, right? Like he's full of energy, he's full of passion, and he convinced student P to loan him about $130,000 to do a flip. He gave the full $130,000 at closing. He didn't withhold any money for construction or the rehab, or to have it inspected to make sure the work was being done appropriately. He also made a loan to an LLC and did not receive any personal guarantees. So again, loaned 100% of the purchase and repairs. Borrower was fraudulent. After foreclosure, the house he was only able to recover about $70,000 of the 130 that he had loaned. And unfortunately, he made this loan about 2 weeks before he ran into me at a RIA event, and he started asking me questions. And just judging by the look on his face, I knew that he had put his money in harm's way, and it was going to end ugly for him. And unfortunately, it has. He lost a good $60,000 of his retirement. Now, that is a negative for sure, but one of the positives of that is, it's not like he had $130,000 in stock that dropped to nothing. He was able to recuperate some of that money. And had he done more due diligence and had his lending criteria in check, he never would have made that loan. And he certainly wouldn't have given 100% of the money up front right then and there. And he would have been protected to a higher degree. And that's, I think that's, is that the last one? Pardon me, I'm gonna take a quick sip of water. So that is, those are two examples of falling in love. And in this case, there was no skin in the game in either case, really. So had there been skin in the game, that borrower may have actually flipped the house and let it just sit there. He took the money and used it in another property, which is common. But because of these mistakes here that you see on the screen were made prior to the note being created and the loan being funded, it put the lender in a very precarious position to where his hands were tied. And to Nate's point, if you only say get interest payments on every 6 months, well, there's 6 months. You don't know what's going on with that project or that borrower. and you'll have to wait all that time until there's a default trigger for non-payment. In this case, he gave everything up, and it wasn't paid, but he was so upside down with, he believed the comps, he believed the rehab estimate, the whole 9 yards, and gave him all the money, which are just a bunch of cardinal sins. And I only identify this guy as student P because I don't want to embarrass him, but his story is so vital. It needs to be heard because this happens more often than not, but more often than I'm comfortable hearing about it. Let's put it that way.
Hey, Keith. So yeah, again, great stuff because, all this stuff, people make mistakes. It's great to learn from the mistakes. And I just want to point out again, you've got some great points here. I just want to drill these down to some of the listeners and the viewers out there. If you are using your IRA and you're loaning to an individual, always close at a title company. That's one thing first. How many times have you seen somebody go, I trust this investor. He says he's going to handle the documents, and they don't actually go through a title company. They don't go through an attorney's office. And then they find out they're not even secure by the property or something crazy like that. Always close at a title company. But if you're loaning to an LLC, this is important, still close at a title company, but ask for a personal guarantee because there's nothing to attach it to. When you have the LLC, they can just dissolve that LLC, and then you're just kind of left with an empty bag there, and you don't have any individual to go after. So, and most investors, real estate investors, are using an LLC. So, if I'm going to loan to an LLC, that's fine, but I'm going to ask for a personal guarantee to help protect me on the back end. Again, other points: make sure you charge monthly interest, so you know that the borrower's getting in trouble. And I think one of the kind of underlying things too is making sure that you're setting up a deal where the borrower can perform. I think this kind of goes back to a lot of the points you were making too, is make sure they have skin in the game, but make sure that when you're doing these loans too, that you're also, at the end of the day, you want your borrower to perform. I've often seen this, is that a IRA lender might be charging 15, 16, 18%, and they're thinking, wow, yeah, I'm getting all this interest. Well, does that enable your borrower to actually perform when they have that much of a payment to make? So there's always this kind of fine line as to, you want to make money and you want to continue that relationship, and you don't want to end up in a situation where your borrower can't perform or you're not protected. So these are great lessons to learn from. What other things can you think of off the top of your head? Other mistakes that people have made that you see just happen over and over again?
Not insisting. Well, to your point, closing at a title company, because the title insurance is the first policy that it's if I don't have it, I don't close.
Yeah.
Then you get into the property insurance, right? So there will be a homeowner's or a landlord's policy in place from a physical damage, all risk physical damage, for example. And look, living in now you're in Florida, but having been in the Gulf Coast, we get these things every now and again called hurricanes. Right. So I demand flood insurance, right? Yeah. Even though it's a hassle, but the way I look at it, I want to save people money and I want to make sure that they can operate. But at the same time, if they can't come up with $400 at closing to secure and insure my the asset that I'm loaning on, then they're not my borrower.
Yeah.
So those are some of the things, and really, not withholding the repair costs in escrow. Huge mistake. Right?
That's a big one too. Yeah.
That's huge. So like my personal house, that's how I was able to take that Spring Branch house and really parlay it into, I had some help. I remodeled the 3 bedrooms myself, and then we flooded. So the National Insurance Flood Insurance Program helped me get my kitchen, bath, all new wiring, the whole, really elevated that house up. So I got a stroke of luck. I never thought having my house flood would be lucky, but in that case, it was. But even in that case, I think Wells Fargo had bought my mortgage. And so the check comes to me and it was, I forget, the $90,000 or whatever. And I have to sign it, send it over to Wells Fargo because they're the mortgagee on the, they hold the first position. And it's the same thing as a private lender, right? I make sure that I'm listed as the borrower or the lender or the mortgagee on the policy. I make sure the policy is kept in force. And I also come from the insurance side, so I'm a little in my day job, so I'm a little paranoid about that. So, but if people do have questions, like, I'm happy to answer about why I insist on the insurance policy.
Yeah, and we've actually got some good questions here. I'll probably save them until you're done with your slides, but just
okay,
we've got some good questions here. We'll get to in a sec.
But like trusting comps, not doing your own comps, or at least get an appraiser. If you're not going to do your own comps, like I've done enough real estate investing and paper day trading and actual property, investing in loans that I'm comfortable comping a property myself right now. I know what I like to look for, and I know how to pick out, pardon my French, the BS from broker price opinions and CMAs and all that kind of stuff. Because they'll just throw anything in there that supports their opinion of an inflated price. It's my job to get the accurate price, which normally means it's less than the borrower's price, but I want accuracy in case something happens. So I can say, I'm going to have to hire a realtor. I'm going to lose 6%. I'm going to have to stage it, boom, boom, boom. Does this make sense? Okay. Yeah. Move forward. And then, that's, I'm kind of rambling on a little bit, but I mean, mistakes, I got all day. So, that I've made. But I say, let's jump into some Q&A.
Yeah. So I'm just going to go from top to bottom here.
Okay.
And I'll
I got
ask
one more slide. If anybody wants to ask me any questions after this, and just want to have a chat, I'll do, because of my relationship with you, Nate. I'll give them a 15-minute consult. I'm not selling anything, just, where they are in with their IRAs. Are they new? Or they want to be a lender, and just see where they're at. It's not a sales call. It's just to get people going. And that's what I'm trying to do with the academy, is to piece the education, shorten the learning curve, and then connect the people with money with the people who need it. So awesome. Anyhow,
yeah, and we appreciate that. So you guys take advantage of that. Again, Newview doesn't promote any products or services or investments, but this is education, really, is what we're providing here. And Keith has a lot of that. So from an experienced investor, let's answer some questions here. And I'm just going to go top to bottom. Some of these are IRA stuff, so I'll just take those. But okay. Why are returns from lending tax sheltered when returns from investment deals involving debt can incur UBIT tax? So that is a great question. And oftentimes people get confused with what this UBIT tax really is. What UBIT is, it's unrelated business income tax, or another form of UBIT is unrelated debt finance income tax. You only run into this tax on very specific investments. One is if your IRA is owning debt leverage property. That would mean owning a house and your IRA got a loan to help you buy it. That's not a note. So your IRA is borrowing money, but your IRA doesn't own a note. It still owns the property. So when your IRA owns something that's debt leveraged, your IRA has to pay a small tax based on the amount that it borrowed, because you got to figure the IRA didn't make 100% of the investment. Why should it keep 100% of the profit tax free? One of the ways to bypass unrelated debt finance income tax is just not have any debt. A note doesn't have debt. Even if you're in a second position, you're not debt leveraged. You just have a note secured by real estate. So what we always used to say in our training is, if you don't want to pay UBIT, loan, don't own. So the other side of UBIT, which doesn't really apply here, some people might make the argument, well, if you're doing a lot of notes, could that be considered running a business, where you would be subject to unrelated business income tax? I've never seen it where somebody is just doing individual notes that the IRS came knocking at their door and said they're running a business. Think about when you buy and sell stocks. I mean, people buy millions, thousands and millions of different stocks. It's not running a business. So what I'm doing, or what Keith is doing, is we're just doing individual notes. It's just an investment. We're not running a business. We're just finding investments for our IRA. But great question. It often gets a little confusing. Sometimes we throw that UBIT tax in the equation, but UBIT only applies to owning debt leverage property, running a business out of your IRA, which is more common. Like if you're owning an ice cream shop, that's an actual business, not buying and selling notes. Or if you are renting personal property. Again, you don't see it very often, but great question. Alan asks, I'm an experienced real estate developer and investor. How can I connect with your clients to properly invest their funds in profitable projects? Get this question all the time. And Keith, you're very familiar with how self-directed IRA companies work. We've got clients, yes, and I kind of mentioned we've got 15,000 clients. A lot of them are lenders. How does somebody with an investment opportunity approach those lenders? Unfortunately, it can't just be through me, but it can be through these types of public educational events. So I know this right now is being streamed on Facebook, YouTube, and maybe even LinkedIn. Those are public spaces. I've seen Newview clients or people looking to raise private capital put their information, in there. consult with an attorney. Obviously, you want to be careful if you're raising money and you're running through like an SEC, a fund. You can't market certain investment opportunities in a certain way. But how do you find people? You really got to come to things like this and do a little bit of networking. Now, I know the pandemic kind of threw networking into a whole kind of whacked out situation. But as things get safer and we open back up, we're going to start seeing people get back out there and network. So right now, if you want to find New View clients specifically, the best way to find them is through New View events. And we do have some live events coming up here in Florida. Check our website. That's the best way to connect with clients, is actually meet them face to face or through some of the online stuff that we're doing here. Another question, you mentioned funds deposited with New View self-directed IRA can also be invested in stocks. How does that work? I'll save that for outside. We'll email you on that. That's kind of just a side topic, but yes, you can have your funds in your self-directed IRA here invested into other things other than alternative assets, like stocks or even crypto. Let's see, going down the list. Can you tell us where, oh, here's one. I'll let you answer this one, Keith. Can you tell us where to find sample notes or templates or other keywords to identify some?
Ooh, great question.
Yeah.
Yes. So this one gets sticky. So yeah, you can look up, I would ask first, go look at your own mortgage or your mortgage, your brother, sister, your family member, whatever. There's a great way to go just see a promissory note and a deed of trust that is drafted by an attorney. And I caution this. It's a great question, but it also makes me nervous because a lot of people want to recycle documents, and I say absolutely not. I demand and the borrower pays, in addition to any transaction fees or any funding wire fees, the borrower pays all that. They also they pay for the promissory note, those documents, the deed of trust that's paid. That's my lawyer, because while you can have the title company lawyer draft your documents for you, which I have done early on because it was easy and it removed some friction. It was just one less phone call to make. However, that attorney does not work for me. Their client is the title company. And since it's my money and my IRA and my terms, it's going to be my attorney that drafts those documents. And unfortunately, attorneys aren't going to just throw those out there willy-nilly. However, if you email me directly, I can give you a copy of some old notes that were drafted here in Texas, but I will put a huge caveat on it. Do not reuse them. Every investment is, I don't care if it's the house next door. You got two houses, one next door to each other. Every investment is different. Don't recycle your documents and have, the attorneys draft them, because they're going to be the trustee, and they're the ones that you're going to call if something happens.
Yeah, I'll piggyback on that. And remember, from my standpoint, guys, I can't give investment advice. I'm just giving you education, even though I do this, my specific position prevents me from doing it. So again, this is just food for thought. But going back to what Keith said is, yes, look at using a lender's attorney. Don't use the attorney of the borrower, because that most likely is going to have the borrower's interest in mind over yours. So use a lender's attorney. Don't recycle documents, and don't be afraid to get a good attorney. Is it gonna cost? Yes, but who should pay the cost? The borrower. Kind of what he mentioned. Anytime that I'm setting up a note for a borrower, think about it. If they go to a bank, does the bank charge fees? Does Bank of America charge fees? Yeah, Bank of America is not paying your doc prep fee. You're paying it. Go back to your mortgage. Go back to the settlement agreement and see who's paying the charges. It's always going to be the borrower. So in that scenario, it should be no different when you're using your IRA to be the lender. The borrower really should be paying those fees. And here's the other cool thing, again, with self-directed IRAs, and even clients miss this sometimes, I will say, is that, obviously New View, we're just a fee service business, right? We don't make money on the investment. We don't take money out of the interest payments that your IRA gets. But in order for us to keep the lights on and have staff process them, we do charge, a transaction fee of $95 to process your note investment, and an administration fee that's annually. It could be $195 to $295. Again, those are fees that you should think about passing down to your borrower. You don't need to pay those fees. And here's the thing, is most borrowers, if they're going to go get money from a bank, think about what the competition is. If they're going to go get money from a conventional bank, what's the conventional bank going to ask them for? If it's investment property, 30% down, good credit, their tax returns, 10-year residency, no gaps, right? Their firstborn, blood sample, right? And then they'll close in 45 days and they're going to charge fees ranging around 3% of the loan amount. If they go hard money, they're going to pay way more than that. Hard money might give them 100% financing, but they're also going to probably look at your credit. They're going to close faster, but they're going to charge, 14, 16, 18% in some cases. So if your IRA is going to be the lender, remember, they're going to be paying fees regardless of where they go. So you should pass those fees on. And if I'm a borrower, I don't know about you, Keith, I'd much rather pay a couple $100 to have a note drafted and pay the administration fee of my IRA lender versus going those other routes, which might be more expensive or more time consuming.
I agree. And also banks are getting clever. They're hiding those fees within the interest rates themselves. Right.
Yeah.
So, and the way they sell the notes around. So they say, we don't have fees. You're paying it. You're still paying it. It may be called something else, but every application goes through, there's a cost to underwrite. I don't care if it's a new note or a refi, and they're getting their fees. And if someone doesn't want to borrow, or the borrower doesn't want to pay the fees to my custodian and my attorney, then they're not going to be my borrower.
Yeah, here's a good question. And it's asking specifically to Florida, but I think we can take this more airplane view too. But okay. I'll just read it because I'm not sure how the questions were. But in Florida, if you loan to a person, they can't claim homestead if they go bankrupt. So I think what the question is really is, okay, well, let's look at it from airplane view. Should you be loaning to somebody in their homestead? Personally, I would never make a loan to somebody with their homestead property for a variety of reasons. One is I'm not in the business to kick people out of their house. That's just not what I want to do if I make a loan to somebody and then they don't pay me. If I'm going to make a loan, it's going to be to somebody on their investment property, because I know at the end of the day, if they don't pay or they don't perform or they don't do the things they said, I'm not kicking them out of their house. I'm kicking them out of the borrower's position, and I might foreclose and take the property. And if it's rented, then I could negotiate to either re-rent that or do whatever. But I'm not going to loan on somebody's homestead. That's just not what I'm in the business to do. Plus, you get into all those other hairy issues about if the person goes into bankruptcy. I've seen nightmares happen because the person chose to loan to somebody's homestead or owner-occupied property versus their investment property. What do you have to say about that, Keith?
No, so quickly, when we talk about private mortgages, private lending out of your self-directed IRA, I'm talking about a business loan, right? Yeah. It's an investment. It's a business. I'm lending it to somebody who's not going to be an owner occupant in that house. Because to your point, as soon as I loan money to somebody for their primary residence, where they're going to live, now we're in federal territory. We're under Dodd-Frank now. And it's no longer a business to business loan. It is a consumer loan, and the consumer is protected. The government considers the consumer idiots. They're too dumb to take care of themselves, but they figure if an investor is doing a business loan, they should know enough that, what the risks are, right? So never ever lend to somebody for their homestead directly. Now, that's not to say that you don't loan on a property to an investor who wraps that mortgage and then sells it to somebody who can't go to the bank and get a mortgage. But that's a conversation for a different day. It's a different strategy. I'm not a big fan of it unless the end borrower knows that there's a first position lien on their house, mine, and then their note to the investor is a second. If they're comfortable with that and they've signed off that they understand it, great. But especially if you're starting off and you haven't done 10 or 20 private loans, stay away from any owner finance stuff. Don't lend to personal or to a personal residence or homestead residence, whether you're in Florida or Texas or anywhere.
Yeah. Here's probably the best question for you. You'll love this one. When and how can I have a consultation with Mr. Baker?
Send me an email and put New View 15 in it.
You got the email there. So yeah, you've got the email there. Shoot him an email. He'd be more than happy to help. And again, going back to the initial question, the individual that said, where do I find some people, if I've got some investments? Well, here's somebody right here who says, hi, I'm a real estate investor. I've averaged 75 flips a year. I'll kind of skip through it. I think most of you guys can read this, but they say, I have excess cash sitting. How do I start to prospect investors to lend to? So this is why we put these on. It's not only for the education, but it's for people looking for money because they have investment opportunities to meet people that have money that's sitting idle. So maybe you guys can connect again. We're not putting people together individually, but you guys are more than happy to, hash that out amongst each other. Another one, Brandon. Oh, go ahead, Keith.
I could throw out, if I also have I have a public Facebook group, the Private Lender Podcast, where people can, I don't moderate it, I try to keep the charlatans out, because you do have to answer questions and make sure that you're a serious either lender or borrower, or mostly lender. But I know a lot of lenders across the country that, they're looking for other lending partners. They're a little short on a deal, right?
Yeah.
And so that is another way that you can put that money to work.
Yeah.
Last night I went to my first in-person networking real estate event in Houston since the pandemic, and it was everything I thought it would be.
Okay.
It was so good.
We'll just leave it at that.
It was so good to be back out there. And so, the thing about a private lender, which we haven't discussed, Nate, is a private lender is a personal connection. It's not a stranger that you just walk up to and say, "Hey, I got a deal," right?
Yeah.
What we like to know who we're dealing with. Nate will tell you there's 3 or 4 people I prefer to deal with in Houston. They'll pick up the phone, tell me about the deal, and I'll tell them yes or no right then. And if I say yeah, then they send me the documents. I do my due diligence, but there's a comfort level there. And I always say, I don't discriminate, but my money does. My money likes gray hair, lots of it, lots of experience.
Well, it is definitely a relationship business. So one thing about private lending, and this goes outside of IRAs, private lending in general is a relationship business. And when you're dealing, again, with your own money and your IRA money, you want to make sure that you really get to know the people that you're lending money to. I would be very, very cautious loaning to somebody that you haven't met or you meet for the first time. I know when, pre-COVID, when we used to do a lot of networking events, there would be, new people coming in all the time and saying, "Hey, I'm a real estate investor. I've got these deals." And that's great. You should do that as a potential borrower, but as a lender, you should get to know them before throwing your money at them the first day you meet them. Do a little due diligence. Due diligence is very, very important. Ask around. Ask if other investors have done deals with this individual. Be very careful of people that show up to one event and you don't see them anymore. So always trust. Don't trust, but always verify. Get to know people. Take them out to lunch. Get to understand where they're at. And you don't need to loan to every single person you meet, because it's like dating. I mean, not everybody is going to be on the same page. And like Keith said, he keeps it very tight. If it's in that band, he'll do the loan. If it's not in that band, he won't do the loan. And that's actually what most of the successful lenders do, is they're very, very conscious and they're very, very diligent about staying within their comfort zone and not straying outside of that. And here's one last question. Is how do you keep them from moving? And I'll let you answer this too. I'll answer it from what I understand, but how do you keep somebody from moving? You give them a loan, it's an investment property. How do you keep them from moving in and claiming homestead? Well, if you have the note drafted right, that should violate the terms of the note, because it should have some verbiage in there that this is for a non-owner occupied residence. And if it's used for anything else, then they've basically gone into default at that point.
Yeah, that's one of those, another trigger of default, right?
Yep.
Like they may be paying you, but if they're moving in, now they're forcing you into federal regulation, consumer regulation. Get them out.
Another last question. Do you set up an LLC with the IRA or solo 401k for lending purposes? It's not a requirement. You can if you want. Now, solo 401k, that's really something you might want to set up regardless. That really for business owners. Solo 401ks, and we're going to have some classes on this coming up. I'm going to do a class on, SEP IRA versus simple IRA versus solo 401k, which is something a lot of business owners ask. But with the solo 401k, if you're setting it up, you're not setting it up because you want to lend. You're setting it up because you want to make large contributions to your retirement. You want to have some check writing ability that the solo 401k allows you to have. You want to be able to maybe borrow from the 401k in the case of emergency. Those are all going to be more prerequisites to setting up a 401k. Lending is just, okay, what am I going to invest in? But I don't see anybody setting up a 401k just to lend, because again, the 401k is more for business owners. But the LLC, now that's a little different. You don't have to be a business owner to set up an LLC. Some people like to set up an LLC that their IRA invests in first. At NewView, we call that what's called a checkbook control IRA LLC. We do offer that here. I would say it's not for everybody. And the only reason you really want to set that up is if you're going to do a lot of investments, a lot of notes where you think you can't wait 24 hours or 48 hours for NewView to send a check. Notes is usually one of those ones where we can fund investments right away. So do you need to set up an LLC, pay for the LLC, pay for the re-registration of the LLC and all the additional fees that come with the LLC just to do notes in the LLC? I would probably say most likely you don't. Most of the investors I see set up an LLC and have their IRA invest into the LLC first are people that are doing real estate investments that have lots of moving parts to it. You're doing a rehab or several rehabs and you've got money going in and out constantly, and you just want to use the ease of use of the LLC versus using NewView. But if you're just funding a note, there's not a lot of moving parts to that, right? All I'm doing, if I'm doing a note to a real estate investor and it's for a year, I have my lending attorney draft the note. I give the note to NewView with my instructions to make the investment happen. They send the funds to the borrower or the title company within 24 to 48 hours. And then I sit back and just watch the payments come in. Why do I need an LLC to do that, right? So again, it saves me money to just do it through NewView. But again, it's really up to personal preference. You can always, contact us here too, and we can kind of, give you some things to think about. Did you see my question about the attorney? Yes, I did. So brand new to note investing here. I'll ask any real estate attorney or specific kind. I think they're asking about when drafting the note. So maybe you can help with this, Keith. Is there,
Yes.
do they deal with a real estate attorney? Is there a specific kind? What kind of advice can you give there?
So so I look, you could start with your state bar to see who's certified when there's, specialized in real estate law, drafting documents, foreclosures. Normally, whoever drafts their documents will probably also handle a foreclosure if need be. I find several attorneys that hang out at the, again, pre-COVID, but there are several attorneys that would, go to the marketing events, pass out cards, they draft promissory notes. I had one, I had a different, I had one attorney draft the documents, but then he was out of town. So we did the foreclosure with somebody else. But yeah, RIA events, things like this. I go out in books and real estate groups in Facebook, and you can, put in looking for a lender to draft, promissory note and a deed of trust. Or is Florida a mortgage state or deed of trust, Nate?
Man, you're putting me on the spot. I just moved here 3 weeks ago.
Okay, fair enough.
I'm used to Texas, though. I'll just be honest.
Yeah, well, I mean, a mortgage is just a two-party contract, and the deed of trust is a three-party. So, I mean, it's just you have that lawyer there, that trustee. But anyway, I look out there, do the networking, and hopefully that. I mean, Florida's already opened up. I've been to Florida twice in the last month myself.
Yeah.
So that's where I would look for those attorneys. Usually they're hanging around, and I found that at least in the Houston market, like you'll see the same guys. They're sort of older, they're sort of established. So they really don't want to have to market a whole lot, but they got to get out there to keep some deal flow coming in.
Yeah, they might have a tie on.
They may. Or actually, I found one at a Mexican restaurant out in Katy where I live one time. I saw him at a RIA event, and then I was like, "Hey, aren't you Steve?" He's like, "Yeah." I was like,
"Yeah."
Hey.
Well, I'll say this. Ask other investors. That's one of the easiest ways. So Keith kind of mentioned most of the networking and stuff is online these days. So check out the local real estate groups. There's real estate groups that are very, very active online on Facebook. You've got access to, Keith's, his outlets as well, Private Lender Podcast, Private Lender Academy. I would start there. Ask somebody else who's maybe a lender, find where the lenders are at and say, who are you using? And make sure that person is in your state, and kind of work from there. That you might bypass all that, doing the research on your own. But again, back to what Keith said, do a little research, make sure that they're local, and find who is doing the paperwork for existing lenders in your state. Oftentimes you'll find it's usually the same person, especially if you're working in a group. A lot of attorneys are just, they find that niche, they carve that niche out, and they're working with, almost every lender in the group. So they're probably experienced in that degree. And then going back to Marina, what I meant is that should I set up, or I would set up an LLC within the IRA? Yeah, that's still what I'm talking about. Is you can set up an LLC that your IRA is the sole owner of. All right. You can either self-manage it, which I tend to think is a little dangerous, or you can just have somebody else be the managing member. Either way, I mean, if you want to set up the LLC, have the IRA own the LLC, and then the LLC does the loans, it's not a requirement. It's just personal preference. If you want to do it that way, NewView's not going to stop you from doing that. Are there good pros and cons to doing it with or without? Obviously, there's no any investment strategy. There's no cookie cutter way that everybody should do it the same way, whether it's real estate or notes. It's really how active are you? How protected do you need to be? And what's the reason most people set up LLCs? It's to protect themselves from personal liability. So if I'm going to buy property or do lending with my own personal money, I don't want anything bad to come back to me personally. So I would set up an LLC to isolate myself from those problems. But when you're dealing with your IRA already is a separate entity from you. So if you're talking, well, I want asset protection, remember your IRA already has a set of asset protection because things are isolated to your IRA. The things in your IRA are not owned by you, and they can't come back to you 99.99% of the time. So you just ask yourself, is it worth the cost to me to set up the LLC? Yes, you can do it, but is it worth the cost? Do I need it? Am I doing it just because someone else did it? Or is there an actual real reason that makes the ease of use of the LLC more worthwhile to me and actually save me in the long run? Again, that is a personal thing that you would have to just ask yourself. But again, feel free to call us and we can kind of, give you some things to think about. I think that was it for the questions. I know we ran a little over, but we've got a ton of people still on. So I do think this is helpful because we've got still, over 50 people still listening. So I want to just kind of end it here. And first, thank Keith for being on with us, man. I really appreciate your time. It's so wonderful that you spend a little time educating and sharing your experience. And what I want to do is offer to you guys out there, let's just go to the next slide, is if you are not a NewView client, we'd love for you to be a NewView client so that you can start taking control of your own retirement, whether you're a lender or you want to just invest in other alternative assets. We have all the alternative asset options here under one roof and then some. And I'm also going to extend an offer to you guys. And this goes to current clients as well. If you think back to that 7 account slide that I mentioned, if you saw an account on there that you don't have that you think you should have, like an HSA or ESAs for your kids, or even an employer plan that you need to set up because you're self-employed, give us a call. And the first 10 people that respond to that email, info@newviewtrust.com, just say, I want my free account, and give us your phone number or a way to contact you back. We will contact you back and get you set up with a self-directed IRA or a group of self-directed IRAs so that you can start investing in notes or alternative assets in a completely tax-free account, like a NewView Trust account. So just email, I want my free account, give us your phone number, and you can send that to info@newviewtrust.com. Keith, again, thank you. Please, everybody, check out his Private Lender podcast and Private Lender Academy. Any final words, Keith?
Thank you for having me on. And anytime, I'm happy to come on and talk, share my mistakes, share strategies. But one thing I would like to say to the audience is, and this is more a you question, Nate, but I highly, highly recommend you go to Roth. Everything. Put everything in Roth. It's tax-free. Every year I take a little bit of money out of my traditional. I put it into my Roth because back to that screen that Nate showed on his slide where Uncle Sam was behind the guy on the table. That's quite apt. And you don't
want to be taxed for the rest of your life. Yeah. So Roth IRA, HSA, Roth 401k, ESA, those are all the accounts that can grow potentially tax-free. Those are all my favorite, but contact us or email info@newviewtrust and we can answer all the questions about that. So thank you everybody for joining us. We'll see you guys next Wednesday.